And this goes deep into the nature of institutional algos and why FVGs aren't always perfectly clear. If algo trading is a program, why can't we identify FVGs with perfect purpose? Here's why. 1. Algos operate with intent masking. Smart money algorithms are designed not to reveal their full intent. They split orders, inject misdirection, or delay fills to keep retail traders in the dark. Think of it like a chess player hiding their next move. Each imbalance may be a trap, not a clue. 2. Algos adapt dynamically. Unlike a fixed script, institutional algos react in real time to macroeconomic releases, volume shifts, volatility changes, prioritize different FVGs depending on context, not just technicals. So even though an FVG appears, its purpose, liquidity, trap, reentry, is fluid. It can change based on unfolding data. 3. Multiple algos run simultaneously. Banks, hedge funds, and quants run layered systems. Some optimize for execution speed, others for mean reversion, liquidity, arbitrage, or momentum. These overlapping algos create conflicting FVG behavior. One algo might fill the gap, another might ignore it entirely. 4. Some FVGs are decoys. Smart money often leaves gaps as bait to lure liquidity from retail traders expecting a classic fill. They may front-run entries or create partial FVGs to confuse pattern recognition. 5. Retail logic, institutional logic. Retail traders look at FVGs in a static chart. Institutions read it within live order books, volume profiles, and macro frameworks. What looks like a simple FVG to retail may just be noise to institutional traders. In short, FVGs are readable but not fully predictable because the code behind them is adaptive, layered, and intentionally misleading. Where the invisible hand of institutions becomes clear. Here's how institutions use fair value gaps, FVGs, to mislead retail traders. Hash 1, fake fill zones, the trap play. Setup. Institutions create an FVG and let price almost return to it, but reverse just before it gets filled. Retail reaction. Traders enter too early, expecting the FVG to fill. Institutional intent. Collect liquidity from retail stop losses, e.g. sell-side liquidity below swing lows. Result. Retail gets faked out. Smart money accumulates at better prices. 2. Decoy FVGs, distraction imbalances. Setup. Institutions leave multiple FVGs on different timeframes. Retail reaction. Retail traders latch onto the wrong one based on bias. Institutional intent. Use one FVG to distract while they engage with another that aligns with macro or volume structure. Result. Retail chases the obvious zone. Institutions strike at the hidden one. 3. FVG plus breaker trap, reversal play. Setup. Price break structure and leaves an FVG. Retail sees it as a trend continuation zone. Retail reaction, buys or sells the FVG expecting trend continuation. Institutional intent, they intentionally fill the FVG, trigger retail entries, and then reverse hard, breaker block behavior. Result, retail is caught in a false trend. Smart money exits or reverses position. 4. FVG during high impact news, chaos trap. Setup, news volatility creates a sharp move and an FVG forms. Retail reaction, traders expect a quick retracement to fill the gap. Institutional intent, use volatility to skip past the FVG and never return, leaving retail holding bad trades. Result, unfilled FVG becomes a graveyard of trapped entries. 5. Time decay FVGs, patience punish setup. Institutions leave FVGs but delay the return for days or weeks. Retail reaction, traders enter early, lose exit just before the real move happens. Institutional intent, flush out weak hands and enter only when ideal volume and macro alignment appears. Result, smart money enters after retail has given up. Final point, FVGs are a smart money magnet, but they also work as mirrors to reflect retail bias back at them. If institutions don't return to fill a fair value gap, FVG, it's often called a failed FVG when the imbalance is never resolved or revisited. Unfilled FVG or stale FVG. If it's left behind and price continues in the original direction without ever returning, some traders might consider it invalidated, especially if market structure breaks away from it permanently. 2. Why might institutions not fill the FVG? There are several reasons why smart money might ignore an FVG. Liquidity is already achieved elsewhere. If large orders were already filled in other imbalances or zones, there's no need to return. Sentiment or fundamentals shift. Macroeconomic data or geopolitical events may force a directional bias that overrides the need to fill older imbalances. New FVGs or inefficiencies form. Institutions prioritize fresher, more relevant gaps aligned with current order flow. Price efficiency has already balanced. The algorithmic intent of smart money might be satisfied even if visually the gap remains. Why must institutions run a best FVG with macro indicators? Institutions don't fill every FVG, they fill strategic ones. They align FVG fills with macro confluence to justify institutional positioning. For example, CPI data or Fed policy can justify filling a large imbalance near key support. Create optimal trade entries. A strong FVG that aligns with non-farm payroll data, GDP, or interest rate news becomes a high probability area. Distribute or accumulate quietly. Macro confluence gives cover for large-scale buying or selling disguised within price movement. Avoid unnecessary exposure. Institutions use macro guidance to minimize risk and maximize timing. If you're learning something valuable from this video, please give it a like, subscribe for more smart money insights, and share it with a fellow trader. It helps the channel grow and keeps the content flowing.